Hello, investors. Nick Shaheen here. And today, I said investors because this is not just for trading. This is for anybody that has an asset in the market. So, this is Apple. We clearly had a correction. It was pretty horrendous, fastest of all time from an all-time high. It was, I've been trading for a long, long time, and this was some stuff that I have never seen before. So, what do we do now? I hear special TV specials and all that about how to protect your portfolio. First of all, these are conversations that they should play up here, but it's not news up here, so they're only after news. So this is Apple 35% below where it was before, or at least it fell as low as 35%. It did bounce quite a bit. And they're still having a conversation. How do I protect? How do I protect? Everybody goes out, well, buy puts, options, puts. Well, that's great, except the VIX, the volatility index, the fear index, is at record levels for what, 65, 70 or whatever. It's been higher, but it's never held this high for this long. And I don't think it ever closed above 80, and last week it did. So clearly we have really elevated levels. So what does that mean? It means that buying insurance is incredibly expensive. It's like the block is on fire, and your house is next, and you're calling trying to get insurance, fire insurance. It's near impossible. Well, in this case, it's not impossible, but it's economically not very smart, not to use another word. Anyway, so, by the way, commercials, down below there is in the description, there's a link to the chat room. Somebody freaked out, lost their mind. How come the link, it's free to try it out, to take a peek how it goes in there. They freaked out because it's a link to PayPal. Well, I have to do it that way. Sorry about the noise. My son is building a race truck downstairs. So it's a way of getting people who are actually engaged, because they pay $0 to check it out. It's not like I'm telling somebody to pay $16 million. I just want somebody mentally committed that's not going to go in there and disrupt everybody else. The room is beautiful. We catch all kinds of trades and we discuss all kinds of investment ideas, but it's not for everybody. So give it a shot. And I'm going to tell you why, because I'm going to give you an idea on how to protect, how about this? How to eliminate your risk in a stock completely, and still stay long the stock. So the idea is, if I had a pile of money invested in, say, 100 shares, 1,000 shares, 10 shares of Apple, let's say, and I'm afraid, because it's 100 shares times $250 a share, it's a pile of money. And I don't know what's going to happen. Oh my gosh, it might fall. What if it loses this? Somebody told me death cross or whatever. And, COVID this and COVID that. So we could fall. Apple could see 160. I'm not calling it down there, but I can see how if, we trip next week and we come out with 25% unemployment and it loses this number right here, that could really start some nasty stuff. We're not there, but let's say somebody's worried about it, and that's why you buy insurance. I've got a nice car. I don't want to crash it. I buy insurance. I don't buy insurance when I think I'm going to crash. I just buy insurance, right? But in this case, the VIX is so high that buying insurance is so expensive that it makes it a crippling decision. Crippling. So how do I do it? So I own Apple, for example. By the way, none of this is a call to action to go out and do this. It's just look into it, and it's an idea that I would do for me. So if I own shares and I want to still be long, but I don't want the amount of money that is at stake for me to be long. So I can do a stock replacement of sorts. So I would dump my stock, sell it, and instead of just doing nothing after that, I would buy call options. What is this? It's a contract, a commitment that guarantees me I can buy Apple at X price if it's higher down the line. What does that mean? Let's say I want to be long Apple through September. I go out to September and I buy a $270 call, for example. It could be anything. It could be $260, it could be $300. And then I'll pay this much amount, $10 if at $300, I'm estimating here. And this guarantees me if Apple runs to $350 or $400, I have the right to buy it at $300 because I paid for the price today. So now if Apple rallies, I'm going to make money because the price I paid for that contract grows, so I can make money that way. And if it runs through that level, then I can make money, because then I convert my position into an actual, my contract into an actual position. You know, I make the call, Mr. Broker, hey, Apple is at $350. Remember, I paid you $10, and now I can buy it at $300. Therefore, I immediately made $40 a share. Perfect. So, but that's a lot of money to buy that contract. It could be $20, it could be $10, it depends on where I buy it. So how do I eliminate that price? I can sell puts at the opposite image. So what does that mean? So it costs money to buy a contract, a call contract. It costs money to buy a put contract. So what I do is I'll buy the call contract and I'll sell the put contract for about the same price. So it costs me nothing to do this, and I'm still long Apple. So where's the risk? The only risk here is, in this scenario, is if Apple falls a lot further. So, but if I didn't do anything, then I'd be losing money from here on, say, to here. So I would have lost another 30%. But if I sell my put here, I wouldn't have lost anything until it falls from here 30%. So in essence, I'm staying long Apple for free. The worst case scenario is if it falls to 150, then I own it at 160. And I'm only lost $10 per share. Versus if I did nothing, I would have lost from 250 to 160 and then on lower. So I'm losing all the way down. Versus I didn't start losing until I get to 160. I made up these numbers. So it could be anything. It could be 180 and 280. It could be 300 and 170. It's personal preference. All depends on what I want to do. But the concept is the same. I get out of my asset, I buy a call, and I sell a put. What does that do? Keeps me long by buying the call, recommits me owning shares by selling the put. Why would I want to sell the put? Because I no outlay out of my pocket. I put my money in the bank from selling the stock, so there's no risk anymore, like that pile of cash. I spent a little money up here, but I collected a little way down here, so neutral cost, no out-of-pocket expense, or virtually no. Depends on which ones I end up buying or selling, but the concept is the same. And so where's the bad news? The bad news is if Apple falls 60%, then okay, I'm losing 20%. But if I didn't do anything, I would have lost 60% anyway. Capiche? All right. Complicated? Sounds super simple to get once you see it in plain, in a picture. Trust me.